Everyone, welcome back to Yuri's Box. In today's video, I'm going to talk about the divergence between the dollar and US bonds. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So, it's Sunday. Yeah, that doesn't stop the headlines from coming out. Yesterday we had Trump basically caving to big corporations basically by exempting technology goods from tariffs. Today we have other headlines. I still haven't read them all. I had Lutnick, come out and say a lot of stuff. Trump is saying a lot of stuff right now. I'll personally wait and see how things shape up tomorrow and and try to make a rough summary of it all. But really, in this video, I want to really further elaborate on something I already spoke about really on my previous videos, which is why on earth have we seen this price action on bonds? And is it something that is completely it's unprecedented, right? Is it something that we've never seen? And is it because potentially people are losing faith in the US? Right, that is one of the possibilities, and very well could be. It definitely, the tariff drama has definitely contributed to shaking things up around the world. But my first instinct on Wednesday morning, when I woke up, I remember seeing this huge candle. All right. And my first instinct when I saw this candle was to think back immediately to the old days, all right, my first days in crypto, where I would see this sort of move on short time frames, or like say your hourly candle or 4-hour candles, 15-minute candles or whatever, where basically someone would get instantly nuked, right, and just get wiped off and liquidated. And so my assumption, as soon as I woke up and I saw this, and actually made a video on it, was to say that this, to me, seemed like forced liquidation. By who? I have absolutely no idea. I could easily be wrong. I've said that many, many times before. But I actually pointed out something that happened in 2008. All right? Meaning, the collapse of Bear Stearns, in our minds, the collapse of Bear Stearns would probably be associated with risk off. Meaning, people are rushing into bonds because it's the safest asset they can buy, when in reality, the collapse of Bear Stearns marked the bottom in yields, which preceded in rallying. Well, they really, depending on where you want to consider from, even here in January, you saw a 63 basis point rally in the 30-year bond. And that comes at a time of great stress in the financial markets, which again is coincides with the collapse of Bear Stearns. Now, something else, I'll add another ingredient in the equation, which is the dollar, all right, before I go any further. Because really what has been troubling people is the fact that the dollar has been collapsing while treasuries get sold off. Because, just in case you're new, imagine this is a dollar. Whenever you see the dollar really go down, that will usually be associated with rates also going down. And usually when you see the dollar go up, you'd expect to see rates contributing to the strength in the dollar, in the currency. All right. This is something I spoke about in relation to the yen. All right. Because inflation going up means that rates have to go up, which strengthens the currency. But this relation has been kind of obliterated as of late, because in reality we've seen the opposite occur. This relation, as of January 13th, well, not really, I'd say the beginning of March, has kind of broken down, because we haven't seen lower rates on bonds. We've actually seen rates go up ever since the beginning of this last week in reality. Because if you go and look, we've actually seen bonds actually do what they're supposed to do. All right, especially last week, the week of Monday 31st, the week of Liberation Day, or Liquidation Day, if you will. But in reality, the problem arises this and the week that just finished. And from Monday, right here, let's go to the daily. Right here, this is where the problems start, because you start seeing the dollar collapse. Well, take a beating of about 4.25% down, which isn't accompanied by yields dropping. You see, yields go up. And so that has really freaked out a lot of people, because what does that say? It says that potentially people are leaving the dollar. And people are no longer seeing the US as a safe haven. And potentially it is a sign that people around the world are losing confidence in the US. Now, as you might have really caught on, I'm really not in that camp. Because just by looking at history, there are a few times where this has happened. And the problem with that is that it usually happens when things aren't looking too good. All right. And again, I do this exercise to look back, simply because we like to think that we're special. We like to think that whatever it is that we're going through today, no one's ever seen it before. While in reality, there are examples of most things that, whatever you go through, it's quite likely that someone else has already gone through it before you. And so I'd like to begin from, excuse me, the December of 06 from till June of 07. All right. So right here, from December of 06 till June of 07, you see bonds sell off by about 18.5%, by really 84 basis points. And at the same time, if you go back on the Dixie, on the DXY, go back to 2008, from December of 06, right here, till June of 07, which is right here, you see the same correlation play out. All right. You continue to see the dollar sell off right here by about 3%, and a significant sell-off in bonds. Now, this is probably not the most dramatic example. The two examples that are quite eerie, in my opinion, is the one I was actually just talking a little while ago. From, March of 08 to June of 08, all right, right here. As I was saying before, from, right here, let's even consider, the first bottom, from January of 08 till June of 08, you see a 64 basis point rise in yields on the 30-year bond. And at the same time, which is right here, depending on whatever you want to pick, would be it March or June. In the same time frame, you have the dollar continue to plummet. And keep in mind, this comes at a time where Bear Stearns is collapsing, right? This is the lead up to Bear Stearns, and Bear Stearns really collapses right here. This is what you see in this marks the collapse of Bear Stearns. And again, you have to think about what people were going through back then. Seeing this correlation break, meaning lower dollar, lower yields, and in fact see lower dollar and higher yields. Would it have not stoked the same fears that same move is potentially stoking today? Moving on, another blatant example of this is the collapse of Lehman Brothers. So right here, in the weeks of Lehman Brothers, on the 15th of September, with this 2-week blip, you see bonds rise by 40 basis points on the 30-year bond. Which is right here. All right, you see the dollar actually sell off, and you have a 4.5% decline on the dollar at the same time where bonds are selling off. And that comes at a time where Lehman Brothers collapsed. This is really the climax of the 2008 financial crisis. And I can make other examples as well, which potentially is even, you can see it, I think a bit more clearly, in my opinion, which is the lead up to the 1991 recession. And if you look from August, all right, right here, of 89 on the 30-year bond, you see rates move from 7.8 to 9.2, which is a staggering 136 basis point move on the 30-year bond. And if you go and look at what the dollar was doing during that exact time frame, again, excuse me if I'm having a bit of trouble with my voice, but it is what it is. From August, which is right here, till September of 1990, keep on going right here, the dollar was going down. All right. Now, as I say many times whenever I look back at history, nothing is the same. Every cycle is different. Every cycle has its own peculiarities. But that doesn't mean that the things that we are seeing today are just totally unprecedented. If you look back at history, there are examples of exactly what we're seeing today. And potentially the bad news, in my opinion, is that what usually follows these sell-offs, these brutal sell-offs in yields, is exactly what I have drawn. I still have it drawn out, actually. This move right here. Bonds seem to not do what they're supposed to do until they do. And they do it a lot. They seem as though there's just this dinosaur of an asset, which, really doesn't do anything for you until it does. All right. Now, am I saying that we're gonna see 2008 or the end of the world. And I always joked about it and said, I'm not arguing for canned corn and hiding away in a bunker. Absolutely not. But what I am saying is that if you look at the things that we've seen, they have occurred during times of great stress in the financial system. And if anything, the fact that we're seeing treasuries sell off, and again, if I am correct in imagining that treasuries are getting sold off because people are trying to raise cash, dollars, on a short-term notice, to me, if anything, it signals dependence rather than decoupling. It means that you need it. And the only way you can have access to liquidity is via the dollar. So although it might seem counterintuitive, in the short term, it definitely looks as though rates could skyrocket. And again, this is simply my opinion. All right, that doesn't mean that I'm going to be right. We could very well be on our way towards a 6% 30-year bond. However, I still remain in the camp as long as the price action really allows me to think that what we're seeing right here is either forced liquidation or, again, well, really, yeah, it could still falls in the camp of forced liquidation. People having to raise capital on a short-term notice because they see things not going their way, be it with a basis trade, be it with local debt you potentially have in Europe, in Japan, and wherever. And so you have to sell the only thing you can sell, which is bonds, because you usually have a lot of them, and that's what you're going to do. You're going to sell bonds, which, again, another thing that really gives me some peace of mind as far as the the dollar not collapsing, is the fact that if you go and look at what bonds were doing, it's not like it was a complete rejection, all right? Because bonds were actually doing their job starting April 2nd, all right? As we move towards liberation, and actually up until Friday 4th, bonds went up. They were going up. They were doing their job. We had a 6% rally when the stock market was going down by, where is it? Right here. By the time April 4th comes along, right here, the stock market is down 12%. Now, is that bonds, just wiping the floor with stocks? No. But arguably, if you go and look back at what bonds usually do in the lead up to a kerfuffle, again, I'm going to be using that word a lot. I absolutely loved Jamie Dimon. In the lead up to a kerfuffle, what you actually see is bonds really not do much. Right? You don't really see bonds do that much at all. That is until they do. And now that I think about it, if I'm not mistaken, we saw actually something similar potentially play out during COVID. Now, I haven't looked at this, but I would be curious to see if actually the dollar was selling off during this time frame. 2020, this would be right here. February 24th and March 2nd. Well, not really. I mean, the relationship between the dollar and it doesn't really play out that much. because I remember, this kind of sell-off, in the beginning of March. But in any case, it is very easy to hit the panic button. And again, I have absolutely no idea what to expect, because again, I kind of, relaxed and tried to take care of myself these last few days. But, having read that, technology is about to get exempted by, from tariffs, that was just like game over as far as I'm concerned. That doesn't mean that, this drama can't drag on a few extra days or weeks. But again, I maintain my optimistic outlook on things, and I think that, well, not really optimistic if you think about it, because my expectation of how things are going to play out is that as time goes on, say perhaps the summer, if the economy continues on this current trend, I don't think we're going to be talking about tariffs. That's something I still hold on to. Again, I'm waiting for anything that will make me change my mind. And potentially what we're seeing in bonds selling off, the dollar declining, could be an indication that there is stress in the system, and people are trying to raise as much capital and liquidity as possible on a short-term notice, which, if you think about it, could actually mean that maybe not next week, but eventually we could see a significant rally in the dollar, potentially even challenging 2022 highs, but that's getting way ahead of ourselves at this point. I mean, we have a pretty big week, and I think that now every week is bigger. After April 2nd, really, it feels like centuries compressed in 7 days or 5 days. Really, it's absolutely insane. So again, just because it feels weird and it feels like we haven't seen it in a while, doesn't mean it hasn't happened before. And I'll finish off by saying that one of the reasons why potentially we haven't seen, something like some dramatic moves such as this one play out in a long time, is potentially because during the 2010s, and I've spoken about this in previous videos, the 2010s were really 10 years of malaise, in my opinion. That's the way I interpret it, where the economy was trying to get over, to recover from what happened in 2008. And so rather than having boom and bust cycles, it was just a slow grind higher. You lacked the booms because people were just too defensive. People were just too afraid of a repeat of 2008. COVID changed that, and it actually jolted everybody out of that state of malaise, and it actually propelled us back to a state which is more consistent, in my opinion, with the pre-2008 world, where you had boom and bust cycles. People overdo it on the way up, and then you have the deleveraging on the way down. Now, again, this isn't me saying that we're going to have 2008. This isn't me saying that you're going to have to go out and buy canned corn. But again, if you go and look back at history, as we've done in this video, the only times you see this mechanic play out, where the dollar is going down and taking a hit, and a big one, and at the same time that bonds are are seeing increased selling. Again, we've seen 2008, we've seen, and again, Bear Stearns and Lehman Brothers in 2008, and 1990, and what you saw in the lead up. All right here. Yields go up, and the dollar, where are you, 1990? Right here, and the dollar goes down. So again, as much as we'd like to think we're special, someone's already done it. Somebody's already seen it. We'll see how this week plays out, and I guess we'll see what Trump has said in this last these last 20 minutes, 15, 20 minutes I've been speaking. And let's see how markets react tomorrow. It'll definitely be a fun week, to say the least. If you like this kind of content, consider leaving a like, and hopefully in my next videos I'll be sounding a little bit more healthy. All right, I'll see you next time. Bye.